This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
We're going to look at question 2 from the paper F9 December 2013 exam. So make sure you've got the question in front of you. And let's have a quick look at the requirements. Always look at the requirements first before you start reading the body of the question. Part A, calculate the cost of equity using the dividend growth model, 3 marks. So the examiner's not too unfair. That should be just pretty straightforward using the formula. Part B, discuss whether dividend growth model or capital asset pricing model should be used to calculate the cost of equity. That's fairly standard textbook stuff. Obviously we'll chat when we come to it. C, calculate the weighted average cost of capital using a cost of equity of 12%. So again, we'll see, but that should be fairly conventional. D, calculate a project-specific cost of equity for card. Well, the minute you see that, it's going to be gearing, ungearing the beta, which you should be confident at, 4 marks. E, discuss whether changing capital structure of a company can lead to reduction in cost of capital. Well, again, you should have realised immediately that that's a fairly standard, primarily Modigliani and Miller discussion. Now, although I'll do the parts in order, A, B, C, D, E, because part E and B are both pretty standard written topics, it might be an idea, or might have been an idea in the exam itself, to do B and D first and at least made a few points, because although it's hard always to get full marks on written bits, it should be pretty easy and pretty quick to get pass marks, and then you can spend time on the arithmetic, which may be very easy. It may turn out to get a bit complicated. Anyway, to avoid confusion, I'll do it in order. So part A, first of all, calculate the cost of equity using the dividend growth model. Well, remember, with the dividend growth model, you're using the growth model formula backwards, in a sense. That on the formula sheet you told the market value, P0 is D0 1 plus G over RE minus G. I've said in my lectures, if you listen to them, that either you should make sure you can rearrange that formula, in that if you know the market value you can work out RE, the cost of equity, or learn it. That I personally would learn it. It is so standard that the cost of equity, rearranging the growth model formula, it's D0 1 plus G over P0 plus G. And write the formula down. You'll get a mark for writing the formula down, even if you've got the wrong figures. Here, the one thing we're not given, we're given market value, we're given the current dividend. The one thing we're not given is the growth rate, but we are given past dividends. And so the dividend in 2010 was 55.1. If it's growing on average at G per annum, the yearly growth rate, which is what we're after, then you'd multiply by 1 plus G each year to grow it. And here, how many years? Well, it's grown from 2010 to 2011, which is 1 year, 2012 is 2 years, 2013 is 3 years. So after 3 years it would have grown to that. It's actually grown to 62. And so 1 plus G is the cubed root of 62 divided by 55.1, which, provided obviously you've got a decent calculator and that you know how to use it, you should get 1.0401, and so G 0.0401 or 4.01%. Let's stick it now in the formula that the cost of equity D0, the latest dividend, the current dividend, I'll do it all in cents, is 62. 1 plus G, 1.0401, divided by the market value, XTIV 716, I'm working in cents, plus the growth rate, gives me 0.1302 or 13.02%. So I don't think that's too bad. It's taking me longer because I'm speaking, but that should be pretty quick. Incidentally, if you used 4% as the growth rate, no problem. The cost of equity would be a tiny bit different, but that's neither here nor there. Let's move on to part B. Discuss whether dividend growth model or capital asset should be used to calculate the cost of equity. Well, as usual on these, I'm not going to write things in full. Just let me make a few points. In the exam, subject to the time, at least I'd try and turn them into sentences. But the main points you'd expect you to mention are that in theory, capital asset and dividend growth rate, dividend growth model, should give the same answer. Remember, and what I'm not going to write down is the way it works. Capital asset is the level of risk determines the return that they want. And using what I've just done as an example, because of the level of risk, maybe they wanted 13%. If they do want 13%, then the return they want is what determines the market value. A dividend growth model is working backwards from the market value. Capital asset is working from the risk. They should give the same answer. In practice, capital asset is regarded as giving a better approximation. It's hard to talk and write at the same time. Or a better estimate. It's based on the riskiness. And the reason is that the problem with the dividend growth model is that it assumes perfect knowledge. You see, and what I'm not going to write down is that in order to use dividend growth model, all right, we know what current dividend is, that's a fact. We know what the current market value is, that's a fact. But we need to estimate the growth rate that they're expecting. We've assumed in part A that they're expecting 4% because it was 4% in the past. But they might have information that we don't know. And if they are expecting 5% growth or 3% growth, then we've done the formula wrong, and the cost of equity would end up being different. So that's basically what he's after. As I said, I'm not going to write more here. It'll just get boring. Part C, calculate the weighted average after-tax cost of capital using a cost of equity of 12%. So no problem there. Cost of equity here, 12%. However, if you look back at the question, they've also got in issue some bonds. And so for the weighted average, we also need to calculate the cost of debt. And here, very, very conventional. This is something you should be able to do quickly. It's redeemable debt. And so we need to set up the schedule and calculate the internal rate of return. And so, if, as I always do, if we do it on $100 nominal, then the current market value, where are we? For each $100 bond is 103.42. The redeemable in 5 years, so there'll be interest each year for 5 years. The interest, they're 8.5%, so $8.50 a year interest, but the company will get tax relief. The tax relief, where is it? The last line, 30%. So the net interest cost to the company, $5.95 per annum, as I said, for 5 years. In 5 years' time, they'll be redeemed. Redemption is at nominal value, so on 100 nominal, we'll repay 100. I'm doing it on 100 nominal. By all means, you could have done it on the full 5 million nominal, but the final answer would be the same. The cost of debt is internal rate of return, so 2 guesses and approximate. I'll guess first of all at 5%. And so the annuity, the interest, 5 years, 5%. The factor is 4.329, giving a present value of 25.76. The redemption, the ordinary discount factor, 5 years, 5% is 0.784. Giving a net present value of 0.74. And so the internal rate of return is slightly more than 5. Now, in fact, because it's so close, in the exam I would have carried on and used 5% as the cost of debt. However, here, just for everybody's benefit, and I suppose if I had time in the exam, I'm always worried, there could have been a mistake. So to prove I know what I'm doing, if I did it at 6% as well, then 5 years at 6%, the annuity factor, 4.212. The ordinary factor for the redemption, 5 years at 6.747. $25.06. And so the net present value, $3.66 negative. Well, the cost of debt itself is the internal rate of return. Well, I'm not going to waste time here. If you're using this lecture to revise for future exams, if you've not got the calculation yet, go back and listen to my lectures. You'll know from there I don't actually learn a formula, because once you've got it, it's relatively easy. It's 5% plus 0.74 over times the difference between 5 and 6, which is 1%, which comes to sorry, that took me a while on my calculator. I get 5.23%. I better just check again. 0.74 divided by 4.41 times 1 plus 5. No, I get a different answer. Sorry, be patient with me. 5% plus 0.74 over Yeah, 5.17%. I'm sorry about that. Well, I'll use 5.17%. It is perhaps slightly more accurate. But I say again, because it was so close, if you use 5%, I'm sure that you'd still get full marks. However, now we can do the weighted average. We know the cost of equity. He told us to use 12%. We know the cost of debt. He told us to use 5.17. We weight them by the total market values. And so the equity, we've 8 million shares at $7.16. So the total market value of the equity is 57.28 million. The debt, there's 5 million nominal. The market value is 103.42 for every 100. And so the total market value, 5.171 million, giving a total for the company of 62.451. And so for the weighted average, equity will take 57.28 over 62.451 times 12%. For debt, 5.171 over 62.451 times 5.17%. Let's see if I can get my arithmetic right. A weighted average cost of capital of 11.44%. And again, because the amount of debt is so small, even if you'd use 5% as the cost of debt, you'd come to the same answer for weighted average, because it's such a small proportion. Okay, where are we now? So we've done A, B, C. All being well, we've got pass marks. We've got 13. However, let's carry on. Now, part D, it's completely separate. Calculate a project-specific cost of equity for card company, and it's something really you should have learnt. It's to do with gearing, ungearing the betas. So, part D. Card is planning to invest a significant amount of money in a joint venture in a new area. We have identified a proxy company with a similar business risk, and the proxy company has an equity beta of 1.038. So the point is, the return we need from this new project depends on the riskiness of the project. To get the riskiness of the project, we've found the proxy company, and we know what the risk of its shares is. There's an equity beta of 1.038. But the equity beta measures the riskiness of the share, and part of the reason the share is that risky is because the proxy is a geared company. And so we need to remove the gearing effect, the actual business risk. We need to know the asset beta, the beta if there was no gearing. And of course you've got the formula for the asset beta. And write it down. You'd get credit for knowing which formula it was, even if you couldn't get the figures in. The asset beta is VE over VE plus VD, 1 minus T, times the equity beta, plus, I'm not going to write down, there's all that second bit on the formula sheet with beta debt, but I write down that we assume always, for these purposes, that debt is risk-free. Therefore, the debt beta is 0, and therefore the whole of that last bit of the formula disappears. So, well, we know the equity beta, 1.038, VEVD are the market values of debt and equity. In the proxy company, I beg your pardon, in the proxy company, we don't need the exact values though, it's a ratio. We are told it's 75 to every $100, 75 is equity, 25 is debt. So we can just stick the figures in. VE 75 over equity plus debt is 25 at the tax rate 30%, so 1 minus 2.7 times beta E 1.038, which gives us an asset beta of I get 0.842. Since he gave the original beta to 3 decimal places, I'm going to leave it to 3. If you had have rounded to 0.84, I don't think you'd lose any marks. Now that gives us the risk of the investment. The return equity to require very much depends on how the project, our share of the project, is being financed. If it was being financed all by equity, then the return we'd want would be fixed by that beta, 0.842. However, we would normally, he hasn't said here, but we'd normally be expected to assume that the company we're considering, card, maintains its current level of gearing in which case, although we know the riskiness of the project is at 0.842, we need to bring in the extra risk, the effect of the gearing in card, and so we need to use the formula again, but this time backwards. We know the asset beta 0.842, we want to work out the equity beta. And as far as the market values are concerned, I know we did it earlier, but it won't take me a moment. The market value of equity at the moment, I'll say it won't take a moment, I've lost it. Oh, with 8 million shares at $7.16. So the total market value of equity is 57.28 million. The market value of debt, VD, 5 million nominal, 103.42 for every 100 is 5.171 million. And so let's stick it in the formula. The asset beta is 0.842 is VE over VE plus VD 1 minus T BE .171 times 0.7 plus 57.28. Sorry, I pressed the wrong button. .90. I said before, I'll do what we check in the arithmetic, but arithmetic mistakes are only the odd half mark. Anyway, now I can get BE. So to get BE, take the 0.842, multiply both sides by 60.9 and divide by 57.28, giving an equity beta of 0.895. Now we can work out what return shareholders would require, and therefore the cost of equity, using the standard formula. The required return They'll be equal to the risk-free rate, which is what? 4%, plus beta 0.895 times, be careful here, the market premium. It says the average equity risk premium is 5%, so it means the market is giving 5% more. If the market had been giving 5, the premium would have been 5 minus 1. However, no problem here, so 4% plus 4.475 giving 8.475%. Okay, finally, we appreciate what we just did was 4 marks. It's a bit of a push, but it was only 4 marks. Part E is a very, very standard 8 marks. Discuss whether changing the capital structure of a company can lead to a reduction in its cost of capital. Well, something he's asked before, I say again, is very standard, very textbook. And the main things you need to mention are as follows. First of all, the traditional theory of gearing. The traditional theory is that the cost of capital will change with the level of gearing. The weighting changes, and with more gearing, shareholders want a higher return, so the weighted average cost in theory will change. Therefore, there must be an optimal level of gearing. Optimal being minimum weighted average cost of capital which in turn would be maximum value of the company. That was traditional, but then along came Modigliani and Miller, and the first time they looked at this, they ignored tax. And they proved that in fact the cost of capital will not change with the level of gearing. That shareholders require a higher return, but the cheap cost of debt cancelled it out. The weighted average stayed constant, and as a result, the market value would stay constant. However, that was impractical because they ignored tax. They then included tax. And if you remember, they found that the cost of capital will fall with higher gearing. But only for one reason, because the only reason that gearing became attractive, or becomes attractive, is that debt interest is tax allowable. It makes debt borrowing cheaper, therefore, and attractive, whereas dividends are not allowable. The cost of equity is unaffected by the tax. And so, as always, I would expand that slightly, but they said a company should be as highly geared as possible. It will lead to a reduction in cost of capital, and automatically, therefore, an increase in the value. The one thing is, though, Modigliani and Miller did make various assumptions. Now, I'm not sure here for 8 marks to what extent he would expect you to go into it, there'll be no harm in, I think with time, in mentioning one or two, that Modigliani and Miller, they did assume, obviously, that debt interest is tax allowable. They also assume that debt is irredeemable. That it's never repayable, whereas in fact, in real life, of course, debt is repayable, redeemable debt. They also ignored the fear of bankruptcy, which is quite important. It was all to do with risk. They said the reason there's more risk for shareholders with more gearing is because of the fixed interest that's payable. They ignored the risk that the company could go bankrupt and shareholders could end up losing everything. They also assumed no transaction costs. It's a relatively minor one, but dealing in shares, there are transaction costs, buying and selling. It was ignored. Now, those are only some of the assumptions, but they're certainly the main ones, and there's more than enough for the 8 marks that were on offer.